Hi, Nikita Verndap here, and welcome to another ANZ Market Digest, our bi-weekly review of what's been happening in the mortgage industry and, of course, capital markets. It's been a bumpy week for financial markets in the wake of collapse of Silicon Valley Bank and, of course, recent increase in the Fed rates. Here to talk about all things mortgage is our head of capital markets, Alex Suslov, and later we'll be taking remotely again with Mike Majidian, wholesale team leader, about more affordable cities on the West Coast. Tune in now so you don't miss a beat when it comes to staying informed about changes impacting your business. Alex, hey, welcome to the studio again. I'm glad you were able to come. Thank you. How's it going?
Everything is going all right, except it's been a little bit of a week lately. Everyone was just rushing here and there, especially on the capital market side. I think New York is just going crazy right now.
Alex, it's been a rough week. What's actually happened in the finance industry and what happened with banks?
It's a very interesting question. Everyone is trying to answer that. Powell just recently was talking about it as well on their FOMC meeting, but let me give you maybe a simplified high-level overview so it's easier to understand for the public. So, long story short, how banks work. They take money from public, from corporate clients, invest those funds into some security instruments, earn some premium on that, earn interest, and pay back to public, right? So people and corporate clients are getting interest on the funds invested in the bank, right? So there are some, so basically let's say you and I go and invest in the bank $1,000, right? And banks plan that there is some liquidity standards if we decide to withdraw our funds right away, and there is certain amount of funds that are being invested long term. Post-COVID, a lot of fixed income instruments went down in price just because the rates went up, and that's how it worked. So basically the portfolio of banks went down in their fair value. But a lot of banks held those instruments on their accounts to maturity, what is called held to maturity, and they have not repriced the values of those. So basically they value them at par, at that same $1,000 that you invested. But in fact, if you go sell those instruments today, you would sell them on like 60 cents on the dollar, basically at $600 in our case, right? But if banks hold it to maturity, they still execute at 1,000 and there is no problem. So when the majority of clients, let's say you and I, if we're the only clients of a bank with our $1,000, go to the bank and say, hey, can you give us back that 1,000 that we invested? And the bank doesn't have any other money, he has to, the bank has to execute those instruments, those investment instruments that they have at their current value. And all of a sudden they will figure out that they owe us 1,000 plus even some interest, and they can only sell it for 600. That's what happened, just because a lot of clients, and with Silicon Valley Bank as an example, the problem is that their clients consisted of a very small kind of group of people who is in close communication with each other, and when, let's say I tell you, hey, I'm going to withdraw my funds from the bank because I don't trust the bank, you'd probably listen to me and like just go do the same thing, right? But some other person who invested in the same bank and I never met that person, he doesn't even know about that case. So when it's a small group of people, it affects the whole bank. That was the main problem.
Wow, that's actually, well, that was pretty simple, but at the same time, that's such a big thing in our world, especially right now. Fed rates hikes, rates up to 0.25, and Fed like 4.75 to 5 today. What does that mean?
Absolutely. Let me continue with Fed. So, for example, to continue the conversation with the bank, what Fed decided to do to kind of cover that gap, right, of the underpriced assets, Fed said, okay, banks, you have an opportunity to come to us and borrow funds considering that asset that you have is worth not really 60 cents of the dollar, but worth par, basically 100 cents on the dollar, right? So Fed would lend money to the bank so they can provide that cash to clients and don't lose funds. That was the decision, which actually leads to additional inflation if we kind of dig into it. And then on a FOMC meeting last week, Powell has raised interest rates by a quarter percentage of a point, and currently the Fed funds rate is in the range of 4.75% and 5%. The current terminal rate for the end of 2023 is at 5.1%, and in 2024, as per Fed's dot plot, they're expecting to start decreasing the rate in 2024, and at the end of 2024, they're looking to have Fed funds rate at 4.3%.
Okay.
Basically, what that means that Fed is still keep an eye on the economy, on how inflation evolves, how employment evolves, and they, even with the bank situation, they didn't drop rates yet and decided to keep it at that pace, see how the economy evolves and how the market reacts.
All right. We actually also receive multiple, I would say, questions from the brokers. I think it will be great if you could help them understand and find the best answer, actually. So,
I love it. I hope those are not embarrassing.
I hope so too, actually. So the first one is, what happens to my mortgage if my bank fails?
Oh, that's an interesting one, you know. I think a lot of people would Google it probably today with banks going down and like hoping that their mortgage would be forgiven. In fact, what happens when the bank fails? It goes into receivership of FDIC, and in most cases, those banks are basically being acquired by another larger financial institutions in the system. So technically, your mortgage would be transferred to another bank, and you would owe funds to another bank, and probably you might have some period where with this transition your payments might go in the wrong direction, you would need to call the bank. So actually it would be a little more headache for you, to be honest, if you need to change the institutions, but overall you'd still be liable for the mortgage, unfortunately.
I see. What is adjustable rate mortgage?
Adjustable rate mortgage. That's pretty easy one. I like the question. So when you get a mortgage or any type of a loan, you have, as far as your rate, you have two options. You can have a fixed rate, meaning that, for example, if it's 5% rate, you will pay that 5% interest throughout the life of your mortgage loan or any type of an installment loan. When it's an ARM loan, adjustable rate mortgage loan, your rate would be changing with some periodicity. It may go up and down based on the current market rates. But for example, you got 5% rate, there's 5 on ARM loan, and during first 5 years you'll have that same rate of 5%, and then after that period, every year or every 6 months, there are different types of program, the rate would be adjusted. It can be 6%, can be 4%. There is also floors and margins and that corridor, which is kind of keeping the rate. That cannot be like 15% or 0%. There is still corridor in the ARM programs.
All right. The last one, and I would say like the most basic one. Could we please talk a little bit about the first-time homeowner mortgage?
First-time homeowner, that's very, very exciting to be a first-time homeowner, right? A lot of companies and programs create special treatment for first-time home buyers. Fannie Mae and Freddie Mac have great programs, as well as FHA for first-time home buyers. You have a lower requirement for a down payment. You can go as low as 3% on a conventional mortgage for first-time home buyers. Very often there are rate incentives for first-time home buyers, and in many cases, when you're qualifying for a mortgage as a first-time home buyer, it's like your new experience. First-time home buyers are required to pass special courses on the mortgages, like on some basic things like ARM mortgages, to be aware of the industry and of the rights and requirements when you're getting a mortgage.
Well, I think that's it for now. I'm pretty sure we're gonna receive more questions next time. I hope you're actually gonna join the show next time too. So, Alex, thank you so much for coming. As always, it's been a pleasure having you here. I'm always glad that you could find the time to join us. Thank you.
Absolutely, Nikita. Thank you so much. It's a pleasure to participate as always. You have a great rest of your week.
You too. Thank you so much.
Thank you.
People were really interested in what we had to say in our last A&D Market Digest about affordable homes on the West Coast. So we invited Wholesale team manager Mike Majidian back to tell us a little bit more about what he's found for Oregon and Colorado. Welcome back, Mike.
Hello, everyone. Mike Majidian, West Coast Sales Manager with A&D Mortgage.
So, Mike, tell us a little bit about the first state, Colorado.
Colorado, beautiful state, middle of the country. You know, you're a short distance to either coast. There's a wide open space, vast hiking trails, mountain ranges, and beautiful, healthy lifestyle. Number 3 on my list is a city called Brush, and with an exclamation mark. In 1978, the city council decided to put that in there just to make sure it shows the can-do attitude that the town brings. A small agriculture community. It has several reservoirs, walkways, wildlife, and numerous outdoor recreation. Number 2 is Colorado Springs. Colorado Springs is the second largest city in Colorado, but it's still small enough to be affordable. In fact, it has been named one of the best cities to live. So it's also known for its wide range of multicultural diversity. But let's go to number 1. Number 1 on the list is Aurora, on top of the list, most affordable city in Colorado, just 20 minutes from downtown Denver. Aurora is thriving, has a very large Korean community, and if affordability is your concern, I think Aurora would be a great choice.
All right. What about the second one, Oregon?
Oregon, obviously an outdoor lover paradise, is known for its diverse landscapes and museum, dining scene, so probably second to none. Number 3 on the list is Kaiser. Kaiser is pretty much in the center of Willamette Valley. It offers low cost of living, abundant outdoor recreation. City also best known as the iris capital of the world. Number 2 is Dallas. Yes, there is a Dallas in Oregon. The number 2 most affordable place to live. And is located in Polk County, about 15 miles west of Salem. It's also known for its beautiful botanical gardens. On top of the list of affordable places to live in Oregon is Springfield. Springfield is located in Lane County, southern Willamette Valley. Springfield offers recreational activity as well as thriving restaurant, craft beer scenes. But it's perhaps best known as the hometown of The Simpsons, the TV show Simpsons.
Mike, thank you so much. I'm pretty sure that was useful for our brokers. Pretty straightforward. Everything is super clear. Thanks again. We thank you for taking the time to watch our A&D Market Digest video. We hope that it helped you gain valuable insights into the current mortgage climate so that you can confidently advise your clients and make moves in the market. We invite you to follow us and stay tuned for more videos like this designed especially for mortgage brokers. Until next time, keep creating success stories.